Hello everyone, I'm John Cunnison. I'm the Chief Investment Officer at Baker Boyer Bank. Thanks for joining me today for this month's market update video. We're going to be covering three topics today. One is U.S. economic strength. The next are tariffs, some of the proposed tariffs. And finally, we're going to talk about what all these things mean for you and your investment portfolios. So beginning with U.S. economic strength. The question that a lot of us have been wrestling with is, can the Federal Reserve increase interest rates at the pace and the magnitude that they have to contain inflation and do so without causing a decline in U.S. growth, a recession, and potentially higher unemployment? As we look 3 years back, back to when they started increasing interest rates in 2022, what we see is that in large part, we've achieved that soft landing that everyone has been talking about. In many ways, the outcome that we're experiencing today is the best that we possibly could have hoped for 3 years ago. Now, talking a little bit about the detail about U.S. economic strength, let's look at growth. If we look at the growth over all of 2024 last year, we saw growth that was right around 3%. Over the last quarter, just looking at the last quarter of the year, last 3 months, we were at 3.3%. So really strong economic growth, much stronger than most economists predicted. Now, what's driving that? Well, many of us know that the U.S. economy, in large part, is driven by consumer spending. And the consumer has been alive and well. We've seen spending that has increased over the course of the last year at about a 1.9% pace. Now, that's a level that is what I would call Goldilocks spending, because it's healthy enough to keep the economy humming right along, but not so strong. Demand is not so high that we see an inflation impulse. Now, the other thing is housing. Housing is really important for the U.S. economy. And one would expect with the pace of increases in interest rates, we'd see some weakness in the housing market, and we didn't. Right? Not that we saw robust strength, but it was a small contributor, actually, new home construction, to overall economic output from the U.S. And finally, inflation. That's the biggest question here, and inflation is getting down to target. The direction is certainly in the right direction, but we're getting to the place where core inflation for the last 6 months of the year, that's inflation excluding food and energy, which tend to be more volatile, but that core inflation, which the Federal Reserve pays a lot of attention to, that core inflation was right at 2% for the last 6 months of the year. And the Federal Reserve is really pleased about that. So ultimately, what is driving the underlying strength of the U.S. economy, particularly relative to other developed economies? Because what we're seeing, this strength in the U.S. economy, is a uniquely American phenomenon. Other countries are not enjoying the kind of economic growth that the U.S. is. Part of that, or a large part of it, is the strength of our labor markets. We have a far more dynamic labor market. Now, there's a lot of theories about why our labor market is so much stronger. Now, and we've talked about this concept a lot in this forum, but two things drive economic growth. How many workers are working? Add an extra worker, you increase output. But perhaps more important is productivity. How much does each worker produce, and how much is that increasing over time? Now, both of those things have been firing on all cylinders in the U.S. economy. We've seen people entering the labor force, both from new entrants and people who exited during COVID and are re-entering, and immigration. So all of those things have increased our supply of labor, meeting the demand from businesses, right? And that's kept inflation under control. We've also seen productivity increasing. So for every hour worked, there is more output. Right? That's really important. And we've been seeing that. Now, how does that compare to other countries? It's just a lot stronger. Why is it so much stronger in the U.S.? Well, here we get in the land of theory. But one of the theories is that the way that the U.S. handled COVID and COVID payments was very different from, for example, Europe. Right? The way we made payments here in the U.S. was we paid unemployed workers directly. We allowed businesses to lay workers off, and we paid those workers directly. In Europe, most of those payments went to businesses in exchange for not laying off the workers. But what we saw after the pandemic was that all sorts of new businesses were created in the U.S., and a lot of the workers didn't go back to their old jobs. They went to these new businesses. So we had new jobs, new industries, presumably more productive industries, and that unleashed a wave of productivity. That's probably the leading theory. But in any case, we are enjoying higher levels of productivity, largely due to a more dynamic and flexible labor market. So I talk a little bit about the strength of the U.S. economy because I know there's a lot going on out there. Today, I think all of us are a little concerned. We've got a lot of big policy proposals that are coming through from the new administration, and there's a level of unease. But I will just say that when we look strictly at the data, we look at the economic data, market data that's coming out, there's a lot of strength in the U.S. economy. That takes us to tariffs. So we can talk just for a moment about tariffs, which are really dominating headlines. Many of you are familiar with what the proposals are, but just as a quick review, President Trump has proposed tariffs of 25% on imported goods from Canada and Mexico, with a carve-out for Canadian oil at 10%, and 10% on Chinese goods, and has threatened tariffs on many other countries and regions, including Europe. Now, if we talk about 25% tariffs on Canada and Mexico, and 10% on, or 25% on Canada and Mexico, 10% on China, what does that mean? And how does that fit in a historical context? I think this chart will provide us a really good view into that question. So this chart shows the average tariff level going back to 1900. So we can see that, the clear story, if you were to write a headline for this chart, it would be that tariff levels have dropped dramatically over the last 125 years, right? As free trade policies have become to dominate global trade. And currently, the average tariff level in the United States is around 2%. Now, if President Trump's policies, tariff proposals, were implemented as proposed, it would drive those average tariff levels up to just over 10%. Right? And in a historical context, that would mean we would be going back to tariff levels we haven't seen since 1940. What does that mean? So how do we interpret all of this? Well, I think that the first thing to understand is that it's highly unlikely that these proposals will be implemented as proposed. Now, is this my opinion? Well, no. If we just look at the market prices. So when these proposals were made, predictably, the market was somewhat volatile, but very quickly the market regained its footing and stabilized. So market prices would suggest that the market assumes these are negotiating tactics and very likely to be implemented as proposed. Now, as an investor who manages my clients' money, I have to at least contemplate what it would mean if they were proposed. Now, if these tariffs were proposed, what would it mean? The first thing I think about is inflation. What would it do to inflation? I think the assumption, a very natural assumption to be made, is that it would increase prices, right? Which would increase inflation. But it's really important to understand what drives long-term inflation and what is a one-time increase in the price level. What drives long-term inflation are big differences in supply and demand. Right? If we look just back to COVID, we know that supply chains were disrupted, supply went down, people got checks, demand went up. That imbalance causes inflation, right? Substantial inflation. What would happen if a tariff was imposed? Well, a tariff is a tax on consumers. It would increase prices of goods in a one-time event, a tax on the consumer. right? Well, very likely what that would do is, going back to our supply and demand framework, is it would reduce consumer demand at the margins, right? So very likely, although it would increase short-term prices, long-term it may decrease demand and therefore even be disinflationary. So we're a little less concerned about the inflation impulse from tariffs and a little more concerned about what it might do to growth and why. Because what would the Federal Reserve's reaction be to an increase in the price level? Right? If we saw that one-time imposition of tariffs, prices go up, the Federal Reserve has told us that they are going to be data dependent. They're going to conduct monetary policy based on what the data tells them. The Federal Reserve, politically, it would be very difficult for them not to react, not to increase interest rates, or at the very least, not raise or not reduce interest rates during the course of 2025 like they have suggested that they would. But we could actually see an increase in interest rates. If that were to occur, it's very likely that that would constrain economic growth. Right? A lot of the good news that I talked about at the beginning of this video might be somewhat in question and challenged. So what does all this mean as we look at financial markets, as we think about how we invest our hard-earned dollars? Let's take the investment choices that we have in front of us one at a time. The first one that we start with is bonds. Right? When we look at bonds, right, the most important thing there is looking at the yield on the bond. What is the interest rate we get from the bonds that we're buying? Well, today there's some good news. And the good news is that with inflation hovering around 2% and yields somewhere between 4 and 7%, that difference is the real yield, right? So we're getting interest rates, yields on bonds that are substantially above inflation. That's really good news. And with some of the underlying strength in the economy, I think a lot of those bonds have high quality. We can trust that we'll be getting those payments. So the bond market looks strong. Now, when we look at stocks, probably the biggest thing to consider with stocks is, and we've all heard this, that U.S. stocks are looking a little expensive. Right? And there are pockets that are more expensive than other pockets, right? Mag 7, big, large cap U.S. tech, it's looking a little more expensive than we've seen historically, right? But with some of the good news, the underlying strength in the U.S. economy, some elevated price level may be justified. And if we look at other areas of the U.S., it looks fairly priced, which should lead us to believe we'll get a return that is similar to what we've seen historically, mid-single digits. When we look at international stocks, it's really important to understand there that although underlying economic strength is not what we're seeing in the U.S., the prices reflect that. So there are much lower prices in international markets. The bottom line when we look at stock and bond markets is that things look fairly good from an investment standpoint, which brings us to cash. You know, a lot of us have excess levels of cash, and I say excess just meaning more than we might normally have simply because the interest rates on cash in money markets has been fairly attractive. And we've held higher levels of cash for many of our clients. Now, today, what we've seen is that in the bond market, intermediate term bonds of high quality, those interest rates are higher than we're getting on cash. And that's something we haven't seen for a long time. So I think it's very important at this time to reconsider where we might have excess levels of cash and get that invested. Over time, we're likely to have a higher return by doing so. I'm going to stop there. Thank you for joining me today. I know there's a lot going on out there, never a shortage of things to talk about, and if any of you have any concerns, questions about anything I said here today or anything else, please reach out to me or a member of your Baker Boyer team. Thanks for joining me.